Hey guys, hope you are having a great day so far. So, not too long ago, I started talking about debt, both national debt and consumer debt, and how this problem was being ignored by most of the corporate media. Since then, stocks pumped in anticipation of a perceived to be dovish Fed, better inflation data and a more bullish outcome for the end of the year. After all, the stock market is forward-looking. It is not pricing in what is happening now, but what is ahead. Well, after weeks of relentless attempts to downplay the dangers that still lie in the markets, trying to pump stocks into fresh new highs, it appears that the delusion we have been living in might be coming to an end. Stocks have hardly been able to sustain their highs. More Fed officials are expressing very serious concerns regarding inflation, with many stating they believe higher rates to be coming down the pipeline. With two back-to-back bad CPI reports, poor earnings from some of the biggest and most important corporations in the world, and even worse, the poor forward guidance and outlook they have for their own ability to generate growing revenues in the future, the case for a bullish reversal of fortunes is not looking like a huge pipe dream. This is why I have been telling you all for all these weeks and months, do not believe the hype. There is much more happening right now than what would be impressed by a bullish day for the markets. Yeah, it is entirely plausible stocks bottomed, but that doesn't mean that we are going to rally up non-stop. You have got to be living in the wild land of delusion to think that inflation, mounting debt, growing consumer debt default, mass layoffs and poor earnings with shitty guidance are going to elevate things into a bull run. We are living in weird times, and with a future as uncertain as it is now, it is impossible for any investor worth his money to say that they are keen and set on a bullish reversal. Hell, even failed journalists, lacking the financial ability to think broadly, are poking fun at Warren Buffett for his bearish stance and lack of going all out of a buying spree. The funny thing is, if you are making fun of the greatest investor of all time for his lack of confidence in the current market, you will have to also call out the biggest corporations, such as BlackRock, in their similar stance to remain liquid at the moment. Today, we are going to examine various pieces of evidence, mostly from consumer debt, that is setting the scene for what is about to happen next. There are two main potential challenges that the United States economy, and therefore the worldwide economy face, and that is employment data and mounting debt. In today's video we are going to solely address the latter, and in Thursday's video we will address the former. Before we start, I would like to quickly invite you all to join the Discord. In the case you are looking for clear entry day trade alerts with guidance, along with a robust community with tons of content, I definitely would suggest you click the link in the comment section. We have been making an absolute killing with alerts, and there is no reason for you to not give us a chance to check us out. With that said, let's talk about debt. There is no easy clever way to put this, so I'll be straight with you. Household debt is threatening the balance and economic health of the entire country. As of me making this video, U.S. household debt has jumped to the highest level since the 2008 financial crisis as mortgages surged amid high inflation and rising interest rates. On a new analysis published by Wallet Hub, findings point that household debt hit a 15-year high at $17 trillion, increasing by $320 billion during the final 3 months of 2022 alone. On average, the typical household owed a total of $142,680 at the end of the year 2022. An analyst for Wallet Hub said, and I quote, "We are not quite at the breaking point, but U.S. households can't afford to take on too much more debt, especially if the economy takes a turn for the worse. People should be thinking about how to shed debt and get in shape for a recession, not assuming a bit more debt will make no difference." Mortgage debt rose by $290 billion last year, the second highest annual increase since the end of the Great Recession. The average household held about $100,667 in mortgage debt at the end of December, just $12,134 below the projected breaking point for a mortgage. If people are carrying debt to compensate for steeper prices, they could end up paying more for items in the long run. This latest data marks a major reversal from just 2 years ago, when households were rapidly paying off credit card debt with the stimulus payment that they received during the pandemic. On top of that, fewer Americans were spending on big-ticket items like vacations because of the virus-induced lockdowns. According to the Federal Reserve Bank of New York's quarterly household debt report, Americans' collective credit card balances totaled $986 billion at the end of the last year, up $61 billion from the previous quarter. U.S. household debt, including mortgage, auto, student loan and credit card debt, grew to $16.90 trillion at the very end of 2022. This 61 billion increase in credit card debt was the largest quarterly jump recorded in the history of the New York's Fed data, which dates back to 1999. The total accumulated credit card debt surpassed the pre-pandemic record of $927 billion. When we look at the number of borrowers who are becoming delinquent, New York Fed researchers found that younger Americans are struggling the most, which should be surprising to nobody. Those that are in the 20s and 30s are missing credit card payments and transitioning into serious delinquency at higher rates than they were pre-pandemic. As card delinquency rates tick up, the trend hasn't even reached the worrisome level yet, in part because the United States is coming off a period of historic lows prior to the pandemic. But this of itself could actually be a huge red flag, particularly when considering that younger borrowers are more likely to have student loan debt that is currently under a payment pause. Once payments resume, those who are already struggling to pay their monthly credit card bills will fall even further behind when they need to also juggle loan repayments. But the problem isn't even only exclusive to customers. The United States as a whole just saw the largest amount of bankruptcies in January since 2010. Bond investors are starting to trim holdings of debt to brace for a possible government default that they see as highly unlikely but potentially seismic for financial markets around the world. Though I doubt the US will default on its debt, I will not call it impossible for it to happen. And all of this serves as a bedrock to give credence to the following analysis from Mott Capital Management, whose market observations and conclusions should serve nor as a warning, but a blaring alarm for us all. The market, as we have seen, cannot catch a break. Whether it's inflation, a global conflict in Ukraine that now threatens the involvement of China, recessions and general instability, the fact of the matter is that equity markets continue to get brutalized, even when they are closed. The latest Manheim used car data showed that used car prices rose by 4.1% through the first half of February, the most significant increase in used cars since October 20, 21. This reflected in the index, which rose to 234, the highest value it has been since July 20, 22, when it stood at 239.6. This provides further evidence that inflation is just simply put, too embedded within this economy and is starting to bubble up again. The used car index price is up 7.5% since November, which points to the fact that inflation expectations will continue to rise. Inflation swaps have also risen dramatically since the CPI report last week. The February CPI inflation now sees inflation at 6.01%, which is up from 5.78% on January 13. The March CPI inflation swap is trading at near 5%. These inflation swaps tell us that the market expects inflation to be persistently higher than previous expected and that expectations for that fast roll-off in data may be far slower than expected. The idea that inflation would come down to 2% by June is long dead gone. In fact, inflation swaps for June are now 2.8%, with Fed officials already talking about how bad they are expecting the situation to become 2024. That's right, we are just starting out 2023 and the Fed is already expressing concern for 2024, but I am sure bulls don't care about that. We have a PCE report coming out Friday, which is expected to show that inflation in January will also be hot. PCE month over month in January is forecast to have increased 0.5% from 0.1% and be up by 5% year over year, which is in line with the December reading. Core PCE is expected to rise by 0.4% month over month versus an increase of 0.3% in December. This will undoubtedly be a huge blow to the hopes and dreams of market bulls that inflation would disappear by the end of this year. But more importantly, all these data we just talked about presents a serious challenge to the bullish narrative, mostly because the higher inflation stays, the higher rates will have to go. Historically, the year-over-year PCE is still more than 1.15% above the 30-year Treasury rate. That has only happened two other times in recent history, in the fall of 1979 and the summer of 1980. Long-term rates have been slow to rise because the market has believed that inflation would be fast to come down. But as we have said many times before in this channel, the longer inflation stays high, the slower it takes to fall. This will have grave implications for the equity markets we so much love to trade in. Equity markets ran in front of the disinflation narrative, forecasting a delusional future that is nowhere near parallel to the real world and what is going to happen. Inflation is here to stay for an uncomfortable amount of time, and the best we can do as traders and investors is to get comfortable being uncomfortable, because it will not go away. Jerome Powell came into that interview a couple days ago and the markets began to run just on his mere appearance on camera, without him saying a single word. We know that retail investors are more active than ever in the markets at this moment, and that a lot of the money circulating markets is directly due to the increased volume. But I was quite shocked how volatile things became, almost like I was trading in a casino. I attribute these market runs or big money manipulating stocks into certain levels, shorter being forced to cover and retail traders gambling into new highs. There will be a moment when the music all these people have been dancing to will stop, and markets could retrace back into serious debts, even marking a new lower low. Again, I am not saying we haven't bottomed yet, it's almost like a 50-50 question because it's impossible to tell. It is not incorrect to believe that there is a disinflationary narrative because inflation is indeed slowing down, but the question you have to ask yourself is how long will it take to come down? I will repeat this for the billionth time. The problem with inflation is that progress is not enough. Inflation puts the economy on a timer before things flip up. Americans, by all the metrics we discussed earlier, cannot hold up much longer. They are using all the credit available to them, and we know through economic data that they aren't buying more products or services. Though there is plenty of room for things to get worse, this does not take from the fact that if inflation isn't tamed relatively soon, millions of Americans will default on credit payments, which could offset whatever health the economy has left. This means even less Americans will be likely to spend. Long inflation also runs the risk of making people more likely to think things will become worse, which affects consumer spending, which is the fuel that makes America run. Things are not simple, bullish, or stable. Right now, the future has this huge question mark that is becoming increasingly hard to see through, and the footing is getting more slippery, which doesn't yield confidence. There is a reason why I've been so bearish on all my videos, even when markets ran to $420 on SPY. It's not because I love being a perm bear. Trust me, I would love to be wrong over the possibility of what America could be like within a year or so if things turn out to be the worst. This is why I advised you guys to not begin buying into stocks heavily yet, because even if we bottomed, the future is too uncertain, and it will be wiser to buy in a bit late than too early and miss an ever bigger dip. Let's continue investing smart, heads above our shoulders, and using all the data before us to make the best decisions. AMC earnings will be on the 28th of this month, so next week. I am looking forward to them beating the expectations. I know my haters love to say I am a shill, but my sincerest hopes are for AMC to survive long term, and though I am not a fan of the board or CEO, I do wish them the absolute best. Theaters are here to stay, and if AMC can pay off its debt and become long-term successful by broadening their revenue streams, I will be very satisfied. Guys, stop playing around and come join my Discord already. We have some serious content that will be of immense value to all day traders, so please give me a chance to just prove it to you. Let me know what you thought of the video down below on the comments below, and I hope to see you on the next one. To the moon.